This week on Sylvia's Traders Lounge.
One of the things that I could tell you from a very clear objective standpoint is that my trading has become a little bit more focused on picking up areas where markets are overextended. So if you want to put in candlestick terms where like we're looking at tails or we're looking at wicks, we're looking sometimes to make trades around those things. But the core approach, the kind of the essence of the methodology has not changed.
Sylvia's Traders Lounge welcomes you all to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. All right. I truly appreciate you, Adam, for making the time. We've been back and forth on the timing, but we're honored to have you again on the Trading Lounge.
Thank you.
We welcome all the new members. Feel free to type in your questions in the Q&A session. I'm also gonna share screen rights to you, Adam, in case you have a presentation.
Okay, I don't really. We had just kind of planned this as sort of open-ended, so I don't have a formal presentation, but I certainly can share screens, and we can go. We can really cover kind of whatever you want to cover today. I can walk you through kind of the basics of how I look at the market, what I look for. I'm certainly happy to take questions from your audience, and so we can just kind of go from there. But where would you like to start? What should we do?
Yeah, so I think we can get started from the last time we spoke. I think you covered especially more to do with the art and science of technical analysis, which is basically your major trading style. So maybe you can tell us if you have added anything to your trading toolkit. If not, it's still okay. Yeah.
Not really, no significant changes, but I am doing, that's a hard question to answer in a very compressed time period, because I'm doing a series of, I have my book back here, a series of 12 talks, one talk for each chapter of that book. And each one, so far we've been through 2, we're scheduling the 3rd, and each talk is 3 to 4 hours. And in that, I'm going through the very specific details of the technicals, but also a little bit about how my thinking has changed and evolved. And I think that this is, let me ask you this. So your traders, your viewers, would you say they're mostly discretionary or more systematic traders?
More discretionary.
Okay, so of course, that's one of the big divisions in the trading world, that the people who, and I don't think it's quite as clear of a distinction as people think, but because good discretionary traders, what they're really doing, you're leaning on systems, but they're systems that are not as, maybe could not in some cases be expressed in computer code. However, the people who are trading purely systematically, there's also an element of discretion, because you have to decide, what are these systems going to look like? Are you going to trade momentum or mean reversion? Are you going to trade, you're going to look for arbitrage opportunities where things kind of get out of whack a little bit. And you're also going to have to make some decisions about how much capital to deploy. How do you know when the thing stops working and you have to turn it off or adjust your risk? There are all of these questions that are still discretionary. But I think one of the things about being a discretionary trader is, if you're lucky and if you do it right, you do sort of experience this, it's almost like mission creep. You think you're doing one thing and you actually end up doing something that is a little bit different over time. Of course, that can be a bad thing, but if it's done right, what happens is the market evolves, the market changes a little bit, and you change with it, many times without even knowing. So I would tell people that I trade essentially the same way that I traded 20, 25 years ago when I started trading. Once I figured out what was working, what I was looking to do was to find spots where a market was having a sharp momentum move and would then have some kind of consolidation and then enter for another move. You know, it's a classic story. You hear so many trading ideas fall into that, whether you call it pullbacks or consolidations or pennants, or, and you know, if you want to make it harder, you can draw some other lines on the chart and pretend you're using Fibonacci ratios and whatever. But really, what's driving that is this idea that market makes a big move, maybe goes a little bit too far, has to take a pause, makes another big move. So that's still kind of the core of what I look at. But the reality is, the way that I structure those trades, the way I get into the trades, the way I manage risk, one of the big questions a discretionary trader has is, so you find your setup, you find your position, you get into the trade, and not every trade immediately goes to its profit target, which, you know, it's something we all realize about on day one of trading. So then the question is, well, like, how much room do you give it? How much pain are you willing to endure? Are you willing to, you know, I've usually been a trader who I'll wait for that consolidation, wait for the pause, and then I'll look to enter with the new momentum. So basically, if you want to put it on a chart, you can imagine like a bull flag, and I'm usually entering a breakout to the upside of the bull flag. So I'm entering when the market's going in my direction. But then there's also the question of, is that necessarily the best way to do that? And I think that one of the things that we've seen, at least on daily charts, is, and you know, knowing that your audience is very currency focused, we've certainly seen this in currencies. We've seen a lot more chop. We've seen, you know, it used to be a few years ago, you could kind of take any pair or any cross and sort of just find when it's moving and close your eyes and take a position, and you're probably going to be okay down the road. You're probably going to be okay a few days or a few weeks down the road, because currencies as an asset class tend to trend quite well, better than many other assets. I don't think it's really been true in the past few years. And this is why, going back, when I say few years, I guess probably to the pandemic, you're seeing a lot of currency traders really struggling. And a lot of stock index traders too, because the behaviors become a little bit different there. So I guess what I'm saying is, if you're a discretionary trader, if you're a sensitive discretionary trader, your methodology evolves, and it might not evolve in any kind of, it's not like you're going to sit down and say, okay, today I'm going to evolve my methodology. Today I'm going to make some big changes in what I'm doing. What happens is, over time, you see these little differences. You see, you know, small points where you start to notice, oh, this is happening in a number of my trades. Maybe we should consider this. And then, you know, you go through maybe a research project in some points, or, you know, you make some very small changes. So I think that my trading has evolved. One of the things that I could tell you from a very clear objective standpoint is that my trading has become a little bit more focused on picking up areas where markets are overextended. So if you want to put in candlestick terms, where like we're looking at tails, or we're looking at wicks, you know, we're looking sometimes to make trades around those things. But the core approach, the kind of the essence of the methodology has not changed.
All right. And speaking of the methodology changing and also cutting across different asset classes, for you being as a technical trader, where has your focus mainly been? Is it stocks? Is it indices? Is it currencies lately?
So more and more, my focus has been, I've been spending a lot of time going back to day trading index futures. And this was something that I did with very nearly complete focus for the first part of the first decade, like 2000 to 2005. My first trading success was in the British pound. I was trading futures, not the cash currency, in the 90s. It was just kind of a case, I think. I don't think I actually was a skilled trader, but I had lost enough money on enough other kinds of trading that I had some idea how important it was to manage risk, and I had some inkling of what a successful methodology would look like. So I then, most of your audience probably knows the history, late 90s, had some pretty good moves in the British pound. And I was fortunate to be day trading those, just kind of right place, right time, and was a good enough trader to not get smashed and maybe got a little bit lucky. But then in the early 2000s, I really switched my attention to trading S&P futures. And that was a bit of a struggle while I learned a new asset class and did eventually figure that out. And that was my focus for quite a while. Then about 2005 to present, I've gone through trading mostly a longer time frame. I've traded everything. I've traded stocks, I've traded options, I've traded spot currencies, futures, pretty much anything a U.S. investor can trade that is liquid. I've traded cryptos. And over the past year or so, I've been focusing very heavily on going back to doing a little bit more day trading. A lot of our swing trading is focused on futures too. I think, to me, there are some execution advantages in futures. There's also fairly significant tax advantages for U.S. investors. So, and this is kind of where I started. My initial trading was before the British pound. I was trading agricultural futures, and the kind of the markets that I knew from the beginning. So I'm not really trading stocks that much anymore. I find myself involved with a stock occasionally. My currency trading has moved purely to futures. I'm not doing spot currency at all, except for some very very focused experiments. But that's, and to me, I don't think the skill set needed to be profitable in one asset class is massively different. I think that's one of the misunderstandings. People think, oh, you're a futures trader or you're a stock trader. There are some subtle differences, but I think if you are a skilled trader, you largely take the same skill set from asset class to asset class.
All right. We welcome everyone who's joined us. We're still going on. And by the way, I forgot to say that your trading bio can be found on our previous conversations. So for those of you who are meeting Adam for the first time, you can also interact with him from our previous webinars, and feel free to type in the questions. So as we progress, Adam, maybe I've been reading The Intelligent Investor, and mostly it's about value investing and stocks and whatnot. I just have one question. Having traded stocks in the past, and then maybe we can move on to another line of questioning. So what would you advise people who trade in stocks in terms of balancing like their portfolio, and what should they look out for when they're looking at companies to either, first of all, trading and investing, which are two different things?
Yes, quite different. So I don't. Framing the question like that, I think, is difficult because I don't feel qualified to tell anybody what they should do, because I don't know how much money you have. I don't know what your risk tolerance is. I don't know you as an investor or person, so I can't give, it's and the answer is different for different people. So I think that is there's kind of an epidemic, I think, in the quote trading education space, where people will definitively say, this is what you should be doing, this is what you must do. And really what you have to do is figure out what's right for you, for your financial situation. And that's why even for an active trader, for somebody who understands how markets move, for somebody who understands risk, you can make a very good case for working with a financial advisor. I want to put that up front. But having said that, I think that the fundamentals do. So, I mean, it's the whole question of valuation, right? The way to think about it is, the way I think about it is that something does have at least a theoretical valuation, but then you have the price in the market, and those are two different things. The question is how, like, that tether between those two things, how flexible is it? How far can it get stretched? And in reality, it seems that that's actually quite a flexible connection. You look at something like what's happening with NVIDIA today, by any measure of valuation, that appears absurd, but at least in the near term, I think if you want to be too contrarian and say, okay, the market is doing this, the market is wrong, I know what the market should be doing because I really understand the valuation, that's a great way to lose a lot of money, because what's going to happen is the market can be wrong, and the market can be wrong for a long time, and the market can be more wrong than you can be wrong, especially if you hold any kind of meaningful position. There's also the issue of what George Soros called reflexivity, which is this idea that the fundamental people don't appreciate enough that price movements can actually cause a change in the fundamentals. And we certainly can imagine many cases where you have impacts on interest rates. If a company's stock price changes, for instance, it will dramatically, it could have dramatic implications for that company's ability to access financing, for good or bad. That could have an impact on the fundamentals. So price movements actually can impact fundamentals much more than people think. What I would suggest is, for most people, unless you intend on becoming a true expert in fundamentals, and by this I mean that you get, let's say, the equivalent of, at least, it's not enough, but at least an MBA level education in accounting and business strategy. And if you add to that a vast knowledge of other companies, like, it's not just enough to be able to look at one specific, let's say, fast food chain and say, okay, here's what I think about their numbers. You have to have deep knowledge of the competitors. This is the equivalent of getting a high level degree. Unless you plan to do that, I think for most people, adding in what I would consider to be casual fundamentals is probably extremely detrimental, because it will make you think you know things that you don't know. It will make you, and even if somebody gives you a piece of information that is true, you don't necessarily know how to weight that information. How important is this? How important is it that this company is issuing this new tranche of debt? What does this mean? You cannot answer these questions casually, and I've seen more and more people over the years get seriously harmed by casual fundamentals. And also, I think the idea, a lot of the books about fundamentals, like Peter Lynch's book's a great book that stands out, but his approach is basically go to the grocery store and find a company that makes something that you really believe in, and then it's extremely narrative focused. And that I just think the market has evolved in a way that I'm not sure that anybody can reliably pull money out based on casual narrative or casual fundamentals. Now, the other thing that I think is worth saying is that one of the most reliable attributes of financial asset classes is that stocks go up a little bit each year, and on average. And I am actually in the camp where I'm thinking we could very well have a decade where that's not true. So this may be kind of rough looking 10 years out, but I would still make the case that for a vast number of people, having some of your money in an index fund makes sense. I do that myself with some of my retirement money. I have significant index exposure, which I massage a little bit with some technical cues. It's not just kind of buy and hold, but I do think you can definitely make a case for indexing. And about my comments on fundamentals, I aren't casual. I think a lot of people do say casual things about fundamentals. A lot of people, what they're doing then is they're kind of cherry picking and just taking the fundamental factors. They want to be long this stock, so they're going to tell you nice fundamental things about the stock, which is fine. They can do that to you, that's fine, but they'll also do that to themselves. So they begin to tell themselves a story that's a weakly conceived lie at best, and then they believe it, and that can have all kinds of disastrous impacts on your risk management. So I don't know if that was what you wanted to hear, but that's how I think about fundamentals for most people.
Yeah, that's conclusive. And maybe having traded for over 20 years now, how important is historical market data in your day-to-day trading now?
Well, it's I mean, it's all we have. It's everything. I executed my first trade in 1995, and once I started to realize if I'm going to anchor my trading around patterns, this means that I have to have an understanding of. So think about that. Most people, when they start to trade, they go to some websites or they pay money for some course or something, and somebody says, these are the patterns you should trade. People get like candlestick patterns or magic indicator patterns, and then they have this idea that, okay, I just look for those patterns in the market, and when I see the pattern, I push the button, I execute the trade, and I'll make money. This and anybody listening to this has probably done that. That's how I started trading, by the way. I fell for the same kind of marketing, but it never works. You will never hear somebody who, over a large sample size, says this magic candlestick pattern made me a lot of money. What you will see are thousands, literally thousands of scammers in the trading and education business, and there's more every day. And what they will show you is, I had a 3,000% return on this very small account using this pattern. Well, a pattern will come and go, but the question is, if you're going to anchor your career on a pattern, or on a set of patterns, or on the way patterns play out, you better know how those patterns have acted over the long history of markets. And I'm certainly comfortable. Like, one of the patterns we're using now is a pattern that I found in some manual research that really has only been in effect over the last 2 or 3 years. I was surprised when I found it. I was very surprised that excuse me, it's a momentum pattern. And I said, intuitively, I'm very surprised this worked. And then when we went, I do a combination of I do a lot of manual, essentially pencil and paper. I use a tablet, but it's very much like writing on a piece of paper. I do a lot of that kind of work. And then I also do a lot of quantitative work. I do a lot of coding. And so the pencil and paper work pulled out this pattern that then the more I verified it, the more time I spent. This does take a lot of time. I was very surprised this worked. When we coded it up and looked back over decades, it actually just started working in the past 2 years. So now that's an interesting thing, right? First of all, it's for me, it's a verification of several levels. It is the fact that I was going through by hand and I found this pattern that worked, and this pattern was very against my intuition. That shows to me that methodology works. I identified a shift in pattern. The longer term coding work also verifies my intuitive sense of what the market does. So there's, then there's a little bit of a question, right? Once you learn something about markets, it's very easy to fall into this trap of expertise where you start to think like, okay, I know how this works, so I'm going to be blind to outside information. And that's something that I have really challenged myself on over the over the past year or so. I've actively sought that beginner's mind, to go back to that frame where I don't really know anything. But now I would ask a question. If you have, and let me ask you this question. So I can show you a pattern that seems to be working very well right now. It's worked for the last 2 years. It, however, did not work for 10, 20, 30 years before that. Would you trade that pattern? What would you do with that?
If it's been working for the last 2 years, I would trade it.
I think so too. That is my approach, because but I think that I would treat it differently in terms of risk management. So if the meaning it's working now, and who knows, it is entirely possible when we graph the performance of some of these patterns over decades, you do see that things have worked and then they stop working. That does happen. So it is entirely possible that maybe this is something that did not work, and now it's going to work for the next 50 years. And I was fortunate to just find that spot where it started working. But I definitely will be evaluating the results from that set of trades, and will be looking for those to be stable. And where my core methodology, I might accept a little bit more flexibility, periods of performance not being so great. If this pattern doesn't look so great, I'm going to be aware that putting it in that bigger picture context shows that it probably does not work. I became a little bit obsessive about this, about researching historical patterns, and I went back, did a lot of work with stock prices, even in the 1800s. The problem when you go back in history, data is not very clean. They didn't keep super good records because they never thought that anybody would be doing the kind of analysis that we're doing. There are commodity prices from Europe in the Middle Ages, and we again, the data is not very clean. And in a lot of these places, what they did was the merchants would not record a price for every day. They would record when there was a large price change. So your time axis will not be continuous. But as best as we can reconstruct, it appears to me with a very high degree of confidence that you could have traded barley in the 1300s in Europe using the same approach that we use for cryptocurrencies today. That the same idea, and I suspect them, we're queuing into aspects of human psychology where FOMO, where a market moves and goes too far and then everybody chases it, or where a market just overshoots value dramatically. Those things seem to have happened. And it's even more interesting than that. The very first written records we have, the clay tablets, the Phoenician clay tablets, are price records. And that price data is pretty spotty, but I did spend some time looking at price data from antiquity. And again, I think we see the same types of patterns. So I have a very high degree of confidence that the core of how I approach markets has been stable for literally all of recorded human history. And this makes me think it's not likely to change in my lifetime. I suppose I could be wrong with that, but everybody, of course, is talking about AI like crazy right now. But this is not news, because when I started trading in the 1990s, we were coming out of the late 1980s when everybody was really very focused on neural nets, which are basically what a lot of these large language models are. Certainly a next evolutionary step there. But it is possible that AI changes things in some significant ways, but I don't think it's very likely. I think that I will probably die trading essentially the same way I'm trading today.
Okay. And I think just for practical purposes, to just also add on to what Alison was asking, if it's possible, just briefly to share your setup or the pattern that you've been trading over the years, for us to just also understand a bit more on that front.
Yeah, it's not, let's see, let me see if I can share. Okay, does that screen share work?
Yeah.
So these are gives you some idea of how I have my charts set up. These are charts on different time frames. What I'm looking for basically is with an awareness of support and resistance and where a market is, like the index futures here. This is the S&P in the lower left-hand corner. This is quite a bit of data on a 4-hour chart, and we're just back in the middle of a range. We're back in a sort of no momentum setup here in the middle of the range, and this is not a point where it's really appropriate for me to have a strong directional bias. That's kind of my high level analysis of any market. Here with these are 30-year bond futures. we've broken below a level, we're in a downtrend. Now, more of a directional bias is reasonable. If we look at a spot currency here, these are, of course, you're going to see, because all of these are truly interest rate instruments, you're going to see quite a bit of correlation between bonds and currencies. Same thing here. So now, this is an area where it might be appropriate to have a little bit more of a directional bias. That's kind of the context that I have. And then what I'm really looking for is for a point here. Let me just drag this chart a little bit bigger. Don't get the idea that I trade just one pattern, but what really makes it work is looking for, like right here where I'm mousing over, markets had a sharp move down. And then what we do is we assess the character of the bounce and look for it to set up another sharp move down. So this is a point where, let me just use a rectangle. So, in this area, this might be a point where we're looking for a short. And a similar spot might be here. A similar spot might be here. That one would not have been a great trade. However, then when you get into this area, and let's see, can I easily change the color? I'm doing this backwards, but let's just do that gray. So the reds actually turned out to be, reasonable spots to look for shorts. But here, the character of this bounce, this was not a spot where I'd have looked to set up a short. And all of this is much more structured, much more, I know that I'm making it sound like, how you feel about these patterns or how we're evaluating them subjectively, but it's really, in the space of a few minutes, this is the basic aspect of what we're looking at. And you can look at this on any time frame, if you want to. Let's just take these down to a shorter time frame. So here's a 3-minute chart with last night's overnight here. So, the same idea. You look for a market to make a big move, and then you have a little bit of a pause, and these are going to be red again. Don't be disturbed by the color, but that would be an area where you'd be looking to take a long position there. You're looking for a pullback. You're essentially trading a pullback, and you're looking for signs of exhaustion or signs of the trend failing. That none of this is complicated, but it's subtle. It's not really possible to say, here's the exact candlestick pattern you trade, because again, I would challenge you to find anybody who has long-term success with that kind of approach. Maybe it's possible. I have never met them, and I've worked with thousands of traders, everybody from at-home traders to spending time on a major commodity exchange. And the people who I have seen be successful through patterns have done it with an awareness and understanding of how small patterns work, but also an understanding of bigger picture context. And for a day trader's perspective, this, so, even if I'm very focused on a 3-minute chart here, I'm still looking at a daily, I'm still looking at an hourly. I'm still, and I might be aware this is a 1-second chart. I'm aware of very short-term flows there, but I want to know what's happening on the bigger picture. I want to know here in the bottom right-hand corner, and this is one of like 6 trading screens I have up throughout the day. I'm sitting in the middle here of 7 or 8 monitors. This is, on the 1-second chart, you see that spike down in a way that you might not see with such clarity on a higher time frame chart. So all of this to me is like, putting lots. I think of it as a synthesis approach. It's like we're putting together many different things and understanding overall, what's the character of this market. And it might come down to, I could show you at this particular point, I executed this trade because price broke out of the high of this candlestick, or, I bought against this little double bottom and I put a stop here, but it wasn't really just because of that pattern. It was because of how that pattern fit in the bigger picture, and maybe even because of what a bunch of other related markets were doing at the time.
All right. That's really good. At least we can be able to see your trading approach. Maybe as we conclude, you can, and people should ask questions at this point if you have any more questions. Maybe you can tell people about your Hudson session if people can
Sure.
to get this analysis, for example, from your bit by bit pieces of your book.
Sure. So yeah, I'm really excited about these sessions. This grew out of, this was a project where, as I told you, I've been trying to go back to this beginner's mind, to the idea of sort of, getting out from under the burden of my own experience and expertise, and, it being so tunnel vision. And so one of the things that I thought would be interesting, I have not read this book. I've certainly referred to it. I've used it when I've coached and trained traders. I've used it as a textbook, but I thought I would try to sit down and read it with the mindset of somebody who was coming to this fresh. And when I thought about doing that, I thought, is there anything I can do with this that would be useful for other people? So it's not just me reading my book. And I came up with the idea. Several groups over the years have done book studies, different, a couple of brokerages sponsored things like that. There were some Reddit groups. There have been various Discords where people would read a chapter of the book and then get together and talk about it. And I thought it might be interesting for me to do that. So I committed to working through each chapter of the book. And it's not, what I will expect you to do before you come to the sessions is you should have read the chapter. I'm not going to read the chapter to you. And I'm not even, in most cases, going to teach the direct concepts in the chapter that clearly. This is not like a college lecture approach. What I'm going to do is talk about related concepts, talk about things that, like I said, in some cases, how my thinking has evolved a little bit, talk about issues of practical application. And like we're doing the trend section next. This is not this coming Saturday, but next Saturday. These are all available on replay. If you want to find the information, probably the best place is just to follow me on my Twitter at Adam H. Grimes. I'll put everything out there on Twitter, and I'll try to be better about pinging things multiple times there. But that's kind of a hub for everything. It's also on my blog, adamhgrimes.com. But in this upcoming session, I'm going to share a lot of research that I've done, some of which I've never shared, looking at all of these indicators that people use for trend strength. So for instance, like ADX, moving average slope, linear regression slope, multiple moving averages. These are all things that parabolic SARs and other thing that people use for trend identification. And almost without exception, these are worse than useless, meaning that if you wait for a trend indicator to indicate that you're in an uptrend, what you actually are doing for most asset classes is if you look forward from that, the market is actually biased downward. So, and this is where many people start with technical tools. They'll start with a higher time frame approach, and they might slap a trend indicator on that. They might think, if this says it just flipped to an uptrend, well, nobody then says, what does that say about the future? That's all that matters. Well, what it actually says about the future is the market's more likely to go down. So these are things that these are kinds of questions that most.
Hi guys, really sorry the session ended abruptly. What Adam was trying to say is that you can find the Hudson session on his socials. Just look out for Adam Grimes on Twitter, and then you can be able to join his sessions where he's covering his book on the art and science of technical analysis. And at least with that, you can be able to ask him more questions that you didn't get to ask during the webinar. It was short, but practical, and we truly appreciate your time, Adam Grimes, and we'd love to host you again in the future. Thank you for your time.